CFDs. You click buy on Tesla, but you own nothing. Here's what that actually cost you.
You think you're buying Tesla. You're not. When you click buy on a CFD, you're signing a private contract with your broker that mirrors Tesla's price. You don't own a single share. You can't vote at the AGM. You can't transfer it to another broker. What you hold is a structured bet with rules that pays you the difference between the open and close. Buy Tesla at $250, close at $260, the broker pays you $10 a share times your size. Tesla drops to $240, you pay the broker $10 a share. Same math, opposite direction. That's the entire product. Everything else, leverage, shorting, financing, is built on top of that one mechanism, a private contract referencing a public price. And the difference between owning equity and renting exposure explains every quirk in this video. CFDs were invented in London in the 1990s, not by gamblers, by institutional traders dodging UK stamp duty on stock purchases. Synthetic equity exposure, no ownership, no tax. By the early 2000s, brokers like IG, CMC, and Saxo had pushed the product to retail. Today, CFDs are the dominant retail speculation tool across Europe, Australia, the Middle East, and most of Asia. And here's the line every regulator stares at. Between 70 and 85% of retail CFD accounts lose money. That number is mandated disclosure in the EU and UK. The broker has to put it on the homepage. That's why ESMA and the FCA stepped in 2018 and capped leverage hard. Major FX pairs, 30-1. Minor FX, gold, major indices, 20-1. Other commodities and minor indices, 10-1. Individual stocks, 5-1. Crypto, where it's still allowed, 2-1. Before 2018, some brokers offered 200-1, even 500-1 on the same products. The cap isn't a tax, it's a guardrail. Now pull leverage apart, because this is where beginners get destroyed. You want $10,000 of Tesla exposure. Your broker offers 5-1 on US stocks. You post $2,000 in margin. Tesla moves 5%. That's $500 on the position. A 25% swing on your margin in a single day. A 20% move against you, wiped. That's the real mechanic. Leverage doesn't change the size of the move, it changes what the move does to your account. So when you see an offshore broker offering 500-1, that's not a feature. That's a flashing red sign that the broker sits outside ESMA, outside the FCA, and outside any regulator that would force them to protect you. 3 costs sit on every CFD trade: spread, commission, overnight financing. Spread is the gap between buy and sell. On Euro US at a tight broker, 0.1 pips. On an individual stock CFD, usually 0.1% of notional. Commission may be 0 baked into the spread or a separate fee, typically 0.05 to 0.1% of notional with a minimum. So far, nothing exotic. The third cost is the one that quietly kills long holds: overnight financing, also called swap. Every day your position is open, the broker charges you the underlying rate plus a markup, usually 2 to 3% per year. Longs pay, shorts usually receive, though with central bank rates where they are, shorts can pay too. Here's what that looks like in real dollars. A $10,000 long CFD on a US stock held 90 days at 5% annual financing, about $125 in swap alone, plus spread, plus commission. That's why CFDs are a terrible wrapper for buy and hold. The product is engineered for short-term speculation. Hold one for a year and the financing alone outruns any dividend you would have collected on the real share. On top of cost, 4 risks. First, leverage cuts both ways, and the disclosure numbers prove it. Up to 85% of retail CFD traders lose. That's not marketing, that's the regulator-mandated number on the broker's homepage. Second, counterparty risk. Your contract is with the broker. If the broker fails, you don't own anything to recover. You have a claim against an insolvent counterparty. That's why client money segregation and compensation schemes, FSCS in the UK, ICF in the EU, matter so much for this product specifically. Third, gapping. Overnight, when markets close, prices can leap straight through your stop loss. Negative balance protection, mandatory in the EU and UK, caps your loss at your account balance. Not every jurisdiction requires it. Fourth, conflict of interest. Some brokers run a market maker model and profit when you lose. Most regulated firms disclose this and hedge externally, but the structure exists. Read the order execution policy before you fund. Which is also why CFDs are banned outright in some places. In the United States, retail CFDs don't exist. US residents trade Forex via Oanda or use futures instead. Belgium banned retail CFDs in 2016. Hong Kong and Singapore restrict them to accredited investors. Brazil ring-fences the product hard. If you're a US resident and a broker is offering you a CFD account, they're operating outside US regulation, and you have no legal recourse when something goes wrong. UK residents get an extra option, spread betting. Economically identical to a CFD, but profits are tax-free, treated as gambling winnings. The trade-off: you can't offset spread bet losses against other capital gains. For most UK retail traders, the tax math wins and they default to spread betting. Outside the UK, that route doesn't exist. So who is this product actually for? CFDs make sense for short-term directional bets where you don't want to own the asset. Currencies, indices, commodities. They make sense if you need to short because CFDs short as easily as they long. No borrow, no locate, no margin call from a stock lending desk. They make sense as a temporary hedge over a physical portfolio. And they make sense if you already have an edge and you're using leverage as a tool, not as a hope. They do not make sense if you want long-term wealth building. Buy real shares in a regular brokerage. They do not make sense if you're learning to trade. Start on demo, then small spot positions, not leverage stock CFDs. They do not make sense if you don't understand overnight financing, because carry will eat you alive on long holds. And they do not make sense at all if you're a US or Belgian retail client. The product is banned where you live. When you go to pick a broker, the bar is simple. Tier 1 regulation, FCA, ASIC, SISEC, BaFin, not an offshore license. Listed on a major exchange where possible. Published percentage of losing clients, negative balance protection, and a total cost, spread plus commission plus financing, that survives a calculator. Anything below that bar isn't a broker. It's a counterparty hoping you're one of the 85%.
Now you know what a CFD really is. Full breakdown and link in the description.